welcome to the Deep Dive. Today we're diving into Afcons Infrastructure Limited.
Sounds good.
You sent us some really interesting material, excerpts from their Q2 2025 earnings call.
Okay.
We really want to get a sense of their business model,
Sure.
how they see the industry, what risks they're facing.
Right.
So it's like a sneak peek into their strategy meeting.
Cool.
Before we get ahead of ourselves, though,
Yeah.
let's start with their history,
Absolutely.
because it really sets the stage
I agree.
for where they are today.
Yeah. Their origins are unique.
They started in 1959
Okay.
as a Swiss-Indian partnership.
Wow.
Then in the 70s, they transitioned to employee ownership.
Interesting.
And they have this long-standing connection with the Shapoorji Pallonji Group.
I see.
It's not your typical construction company structure.
No, it's not.
Like, how does that even work?
Right.
Well, it's this really fascinating mix of employee empowerment with the backing of this major conglomerate. And it seems like that's contributed to their success. They've had consistent double-digit growth over decades.
Really?
Even hit 16% in the last 5 years.
That's impressive.
Especially in such a volatile industry.
Yeah. That is remarkable.
So let's talk about their business model.
Okay.
They have these 5 distinct verticals.
Right.
Urban infrastructure.
Okay.
Surface transport.
Got it.
Hydro and underground. Marine and industrial. And oil and gas.
Wow. They really do have a finger in every pie.
Yeah, it's like they've got every corner of the Indian construction industry covered.
It seems like a really deliberate strategy.
You think so?
I do.
To diversify?
Yeah.
And tap into all these different growth drivers in the Indian economy.
Exactly.
But it's not like they're just spreading themselves thin,
right,
taking on every single project.
Yeah, they're not just a jack of all trades.
They seem to have expertise in all of these areas.
Yes, especially in these really complex, high-value projects.
Yeah, they really aren't afraid to take on the tough stuff.
It's true.
You know, massive bridges, intricate tunnel systems, deep sea construction.
They've even got 16 tunnel boring machines.
Really?
Yeah.
That's a serious investment.
It really is.
So they're clearly committed to this.
Oh, yeah. It shows they're not messing around.
They're ready to handle the toughest engineering challenges.
And that's a big part of their risk management strategy.
Wait, really?
Yeah.
How does taking on these complex projects help them manage risk?
Good question.
Those seem inherently risky.
'd think so, right?
Well, here's where their approach gets really interesting.
Okay.
It's not about chasing every big project.
Right.
They have this really disciplined, gonna-go framework.
I see.
They evaluate every opportunity against a specific set of criteria.
And what are those criteria?
Things like risk profile, cash flow requirements, profitability targets.
Interesting.
And if a project doesn't meet those criteria, they're willing to walk away.
Even if it seems lucrative on the surface.
Wow. So it's about being really selective.
Exactly.
Choosing their battles wisely.
It's like they're not just builders.
Yeah.
Strategic partners.
Okay. I like that.
Who are carefully assessing every opportunity.
Okay. I'm with you.
And this disciplined approach is reflected in their ideal book-to-bill ratio.
Okay, what's that?
It's a way of measuring the relationship between the value of new orders they secure.
So the book.
Yes, and the revenue they generate.
The bill.
Right.
But what does that ratio actually tell us?
So a ratio above 1 means they're securing more new orders than they're currently billing.
Strong future growth.
Exactly. But if it gets too high, it could signal that they're taking on too much.
I see.
And might struggle to execute effectively.
So it's a balancing act.
Right. A ratio below 1 means they're billing more than they're booking, which could point to a future slowdown.
Got it.
They aim for that sweet spot between 2.5 and 3.5 to balance growth with execution.
So finding that perfect rhythm. Between securing enough work, but not overstretching themselves.
Exactly. It's a sign of a company that's thinking long-term.
Right.
Planning for sustainable success.
Not just chasing those short-term gains.
Precisely. They're managing their growth carefully.
Makes a lot of sense.
Now let's talk about their geographic focus.
Okay. Their footprint.
It's another key aspect
of their business model.
Exactly.
Right now they're split. Around 85% domestic projects. And 15% international.
Got it.
But they've mentioned wanting to shift that.
To what?
To more like a 70-30 split.
Wow, that's ambitious.
Yeah, especially considering how bullish they are on the Indian market.
It is, but their history suggests they can handle transitions.
True. They started with international roots.
Right.
And they've already got a strong presence in Southeast Asia and Africa.
So they're not starting from scratch.
Not at all. But why the renewed focus on international expansion?
Good question.
Especially when the Indian market is doing so well.
Well, it's smart from a risk management perspective.
You think so?
I do, by diversifying.
Yeah.
They're less vulnerable.
To what?
To, like, economic downturns or policy changes.
In any single market.
Right. Spreading the risk.
Not putting all their eggs in one basket.
Exactly. And they're not expanding randomly.
So they're being strategic.
Very much so. They're pushing into Saudi Arabia right now.
Okay.
They see it as a high growth market. More contractor friendly.
Than other parts of the Middle East.
Yeah. Why do you think they're hesitant about the wider Middle East?
Well, it seems like there'd be tons of opportunities there.
There are, but they've learned from experience.
Oh, really?
Some Middle Eastern markets can be challenging.
In what way?
They're worried about cash flow issues.
Okay.
Payment delays.
Yeah, that makes sense.
And the lack of robust dispute resolution mechanisms.
So they're being cautious.
They are.
Prioritizing markets where they feel confident.
About getting paid.
Yeah.
And minimizing disputes.
It's all about protecting their profitability.
Exactly. They're not willing to compromise.
For the sake of growth.
They're looking for markets that align
with their values.
Their risk appetite.
It's all connected.
Their commitment to sustainable, profitable growth.
I'm seeing a pattern here.
What's that?
Disciplined. Strategic. Focused on the long term.
Exactly. But let's not get carried away with their future plans.
True. We should look at their current performance.
Let's dive into the numbers.
This is where it gets really interesting.
Can't wait. Okay, so let's dig into those Q2 and H1 2025 financials.
Yes, let's talk numbers.
Like we said, record EBITDA margins.
Yeah, those really stood out to me.
But they also had that slight dip in revenue.
And the increase in debt.
It's a mixed bag.
Yeah.
It's really interesting.
Yeah, those record margins are impressive.
They are.
It shows they're focused on profitability.
Right, not just growth for the sake of growth.
Exactly, but what about that revenue dip?
Well, those delays definitely had an impact.
The election and monsoon ones?
Yeah, particularly on government projects.
Oh, right, because of the bill certifications and payments?
Exactly. Things really slowed down during the election.
And the monsoons probably didn't help either.
No, they mentioned difficulties with water and bridge projects.
Yeah, makes sense. Hard to pour concrete in the rain.
Right, so those were probably impacted by the weather, too.
So how much of a setback were those delays?
Well, they seem pretty confident about a rebound.
You think so?
Yeah, they said payments picked up in October.
After the election and monsoon season?
Exactly.
So they're expecting to make up for lost ground?
They're sticking to their guidance.
Which was?
Flat to nominal revenue growth for FY 2025.
Okay.
But they're projecting a big jump in FY 2026.
How big?
Between 20% and 25%.
Wow, that's a huge jump.
It is. What do you think is driving that?
I mean, is it just catching up on those delayed projects?
That's part of it, but they've also got a strong pipeline.
Of new projects.
Yeah, particularly those L1 projects.
Right, where they've submitted the lowest bids.
But haven't gotten the official award yet.
So they're in a good position.
They are.
They mentioned having like 7,000 crores worth of those.
Yeah, a lot of potential there.
Did they say which projects those were?
They highlighted some big railway projects.
Right, okay.
The Nagpur-Gondia Expressway packages.
Got it.
And a project for the Defense Research and Development Organization.
Where was that?
In Visakhapatnam.
Interesting.
They expect most of those to be finalized by mid-December.
So a strong start to FY 2026.
Exactly.
Okay, so the revenue picture seems promising.
It does.
But what about that debt increase?
Right.
Is that just because of the payment delays?
They've said it's mainly tied to working capital.
Okay, so they're having to fund projects.
Yeah, while they wait for those delayed payments.
So it's a cash flow timing issue.
More than a debt problem.
But are they doing anything to manage that better?
Yeah, they mentioned some initiatives.
Like what?
Negotiating better payment terms.
Makes sense.
And streamlining their processes.
To speed things up?
Yeah, bill submissions and collections.
So they're not just accepting those delays.
Right, they're actively trying to improve.
It shows they're taking it seriously.
They're also watching their net debt to equity ratio.
Which is?
Currently around 0.7.
Is that high?
It's not alarming, but it's something to keep an eye on.
As they grow.
Exactly.
Okay, so the financials are a bit complex.
They are.
But it sounds like they're managing things well.
And they have a plan.
To improve their cash flow.
And debt position.
Now let's talk about something that really intrigued me.
What's that?
Their focus on knowledge management.
Yeah, that's not something you hear every day.
Not from a construction company.
They even have a chief knowledge officer.
Really?
Yeah, it's pretty unique.
Shows how committed they are to it.
It's like they see knowledge as a strategic asset.
So what does that actually mean?
In terms of building bridges and tunnels.
Yeah, how does that translate into a competitive advantage?
Well, it's a system for capturing and sharing knowledge.
Okay.
Applying it.
From their entire workforce.
Exactly.
So it's like a library of their experience.
Yeah, lessons learned.
Best practices.
Technical expertise.
Even project data.
All accessible to everyone in the company.
So it's not just storing information.
Right, it's about making it actionable.
So they can use it to make better decisions.
To solve problems.
To innovate.
And they've been recognized for it.
Really?
They've won the Most Admired Knowledge Enterprise Award.
How many times?
8 years in a row.
Wow, that's impressive.
It's clearly a core part of their culture.
I can see how that would be a huge advantage.
Especially for those complex projects.
Can you give me an example?
Sure, imagine they're bidding on a bridge. In a really challenging area.
Geologically.
Right. Their system might have data from past projects.
In similar terrain.
Exactly.
Highlighting risks.
Or cost overruns.
So they can submit a more accurate bid.
And anticipate problems.
Maybe even come up with innovative solutions.
That their competitors wouldn't think of.
Like experience is their secret weapon?
It gives them an edge.
Okay, let's shift gears again.
To what?
Risks.
Yes.
They're not shying away from potential challenges.
Yeah, they're acknowledging them.
Even while being optimistic about the future.
They're aware of the headwinds.
And preparing for them.
Exactly.
Yeah.
One of the key risks they mentioned was margin compression.
As the industry gets more competitive.
Right. That classic squeeze on profitability.
More players bidding for the same projects.
Exactly.
Driving prices down.
But Afcons says their focus on complex projects helps.
And their bidding process.
And their risk management.
So they're not just hoping for the best.
They're actively managing their exposure.
Making strategic decisions.
To protect their margins.
So it's about winning the right projects.
Not just any project.
The ones that fit their expertise and goals.
And their risk profile.
But margin compression isn't the only risk.
No, they mentioned a few others.
Like what? Like what?
Well, one challenge they mentioned was skilled labor.
Yeah, with the market booming.
Right, there's a risk of a shortage.
Which could drive up wages.
Exactly, and squeeze margins.
Classic supply and demand.
So how do you think they're addressing that?
Well, they mentioned training programs, right?
Yeah, investing in their workforce.
Attracting new talent.
And they're also looking at technology.
To reduce reliance on manual labor.
Like those tunnel boring machines.
Right. Working smarter, not harder.
What other risks come to mind?
Well, they talked about inflation.
Yes, a big one for construction.
Material costs.
Equipment costs.
Fluctuating all the time.
It's tough.
So how are they handling that?
Well, they're trying to lock in prices.
With longer-term contracts.
Exactly, and they're being strategic with sourcing.
Finding the best deals.
It's like a game of chess.
Staying one step ahead.
What about the regulatory landscape?
Oh, yeah. India's bureaucracy.
That can be a nightmare.
Approvals.
Land acquisition.
Delays.
Unexpected costs.
A real headache.
But they're engaging with the government.
And local communities.
Trying to streamline things.
Building relationships.
Understanding the context.
Working collaboratively.
It's the only way to get things done.
There's that proactive approach again.
They're really shaping their environment.
Not just reacting.
Thinking long term.
It all ties back to their outlook on the industry.
Which is
incredibly optimistic.
They're predicting massive growth.
Trillions of rupees in projects.
It's a boom.
So what's driving that?
Infrastructure development.
The government's plans. Railways, urban transport,
renewable energy.
They're modernizing India.
And Afcons is right in the middle of it.
With their expertise.
They're perfectly positioned.
Years of experience.
A strong reputation.
Leaders in their field.
They're ready to capitalize.
But they're not naive.
Right. They know there will be challenges.
Competition.
Labor shortages.
Rising costs.
Bureaucracy.
But they've got a good track record.
They've shown they can handle it.
It's like this unwavering belief.
In their ability to execute.
To overcome obstacles.
That deliver.
It's pretty inspiring.
It makes you wonder, though.
What's that?
If Afcons is doing so well.
Yeah.
Managing risk.
Executing projects. Sharing knowledge.
Why aren't more companies following their lead?
What's holding them back?
It's a good question.
Maybe a lack of vision?
Resistance to change?
Inertia?
Oh.
Who knows? But Afcons has found a winning formula.
It seems that way.
This deep dive has been fascinating.
I agree.
We've learned so much
about their strategy,
their financials,
their approach to risk,
their vision for the future.
They're definitely a company to watch.
Thanks for joining me on this deep dive.
It was my pleasure.